A club?
Club?
Do you guys know what club is?
Oh, we just learned about this yesterday. Assalamualaikum and hi, my name is Nur Aliana Jiha binti Aminuddin, and today me and my friends are going to present to all of you about clubs and association. Alright, as for the introduction for this topic, I will start by explaining what a club is. Clubs are formed for not commercial purposes, but for other purposes such as social, recreational, sports, arts, science, literature, or other leisure pursuits for the interests and the benefits of the members. So in a simple way, here we can understand that clubs and associations are generally set up for other than business purposes because these clubs are not generating income, but instead they mainly exist to serve the interests and enjoyment of the members. As for example, we have athletic clubs for people who love doing sport activities, antique car collector clubs, and as well as historical societies. These clubs are set up not to do the business or to generate income, but instead they are set up to promote their shared interests among the members. However, it is important to take note that there are some clubs do engage in business activities. These are usually clubs that deals in trade, or we call as a trade dealing, and they do actually earn profits. For example, like professional football clubs or fitness center. For this kind of clubs, the incomes or profit that they generate will be taxable as a business profit just like any other business. Now, let's take a look at how clubs are treated under taxation. A club is usually set up to provide services to its own members and not to the public. Thus, clubs may be eligible for tax exemption, which is known as the principle of mutuality. This principle means that a person or group cannot make a profit from themselves. So, when clubs collects money from its own member, such as from membership fees or subscription fees, it is not considered as taxable income. These tax benefits only apply if the club is truly run for its members and not as a business. Later, we will also see what happens when the club earns income from outsiders or from non-members.
Hi, my name is Adiba Badriah. Today I will explain members under principle of mutuality. Firstly, who is a member? A member is a person who is registered with the club and has the right to vote during general meeting. Next, what does the mutuality principle means for members? This principle is based on the idea that a person cannot make a profit by trading with themselves. So, when a club collects money from the members such as subscription or fees, that money is not considered taxable income. Even if there is a surplus, it's not taxed because it's simply money returned from members to the club, not business profit. But remember, this rules applies only to transactions with members, not with outsider or non-members. Let's take a quick example. If a club collects 10,000 from members and spend only 8,000, the remaining 2,000 surplus is not taxable as long as it came from members.
My name is Nur Nazura Husna and I will continue with dealing with non-members. Who is non-members? Non-members are external individuals who do not contribute to the club as members but may still pay for access to events, services or facilities. When trading with non-members occurs, the principle of mutuality no longer applies and exposure to tax can arise on any surplus that may occur. Examples of trading with non-members include selling event tickets to the public or renting out club premises for private use. Principle of mutuality says a person or group cannot make a profit from themselves. This principle protects clubs from paying tax as long as only members contribute. But when a club deals with non-members, this breaks the mutual relationships. Once the mutuality principle no longer applies, any surplus or profit made from non-member activity is exposed to tax. For example, the 15,000 came from non-members. The cost of expenses is 12,000. So, the surplus of profit is 3,000 is considered as trading income. The principle of mutuality does not apply here because contributors, which are non-members, are not the same as the beneficiaries, which are club members. Therefore, the 3,000 surplus is taxable.
Assalamualaikum, my name is Muhammad Farizwan bin Muhammad Sobri, and now I'm going to talk about accessibility of receipt. First, I'm going to talk about income from members. With effect from YA 2009, any income that arises from transaction with members shall not be taxable under the Act. This would include A. Entrance fee and subscription received from members, B. Provision of services to members for a fee, and C. Sales of goods to members. In addition, any expenses or capital allowances attributable to such income shall be disregarded. A separate account in respect of income derived from its member and non-members must be maintained. Any loss will be disregarded. Income generated from the provision of trading facilities to members is deemed to have carried on a business. It will be deemed as trading receipt and assessed under Section 4A. Okay, next I'm going to talk about the income from non-members. With effect from YA 2009, club will have two sources of income, which is first, income from members, and the second one is income from non-members. Who are non-members? Non-members are those persons who are not entitled to vote at the general meeting of the clubs and societies at where effective control is exercised over its affairs. Okay, next, the tax treatment. First is trading activities from members and non-members within the club premises are profit in nature and subject to tax. The second one is cash donation received from members or non-members is a capital received and free from income tax. I'm going to talk about dealing with non-members. Any dealing with non-members with regard to the following are treated as business income. The first one is fundraising activities or events open to the public. The second one is rental received for hiring out the club's hall or facilities or equipment to the public. The third one is amount paid by non-members to attend dinner or social function or talk or presentation or workshop. And the last one is proceed from non-members on charitable event.
Now, let's look at how we compute adjusted income from non-members, which is important because only income from non-members is taxable. Income from members is exempted. We refer to Section 4A for this computation. The first step is to identify the gross income from non-members. Then, we deduct the relevant revenue expenses, which are expenses incurred during operation. But, since many expenses are shared between members and non-members activities, we use a formula to apportion the expenses correctly, which is A times B over C, where A is the common revenue expenses, B is the gross income from non-members transaction, and C is the gross income from both member and non-member transaction. This gives us the adjusted income. Next, we deduct capital allowance. Again, this need to be apportioned using a similar method, which is D times B over C, where D represents the common capital allowance. Once the capital allowance are deducted, we arrive at the final figure, which is the statutory income. This is the amount that will subject to tax. So, in summary, we only tax the portion of income that comes from non-members, and both expenses and capital allowance are carefully apportioned to reflect that. Now, let's talk about approved donations and how they relate to tax deductions. When a club or society makes cash donations to approved institutions or organizations, they may be eligible for a tax deduction. However, they are only entitled to a deduction of up to 10% of the aggregate income of the club or society. To determine the amount that can be deducted, we use an apportionment formula, which is deduction equal to G times H over I. G represents the total cash donations made under Section 44, subsection 6 of the Income Tax Act. H is the aggregate income from non-member transactions. I is the aggregate income from both members and non-members combined. This formula ensures that only the portion of donations that relates to income from non-members is deductible, as income from members is typically not subject to tax. So, in short, even if a club makes large donations, the deductible amount is carefully calculated based on the income sources to maintaining fairness in the tax system.
So now I'll be explaining briefly about investment income and tax computation in the context of clubs, particularly from a taxation perspective, as outlined in Advanced Taxation TAX667. Let's start with investment income. Investment income for clubs can come in forms such as interest and rents. These are considered accessible income, meaning they are subject to tax in the hands of the clubs. However, dividends received are an exemption. Under the single-tier dividend system, dividends are tax exempt, so clubs do not have to pay tax on dividend income. Moving on to tax computation, it is important to understand that clubs deal with both members and non-members. These dealings are treated as two separate business sources for tax purposes. Revenue expenses that are directly tied to income from either members or non-members are fully deductible from the relevant source. However, when revenue expenses are incurred to generate income from both members and non-members, these are treated as common expenses. Examples include administrative costs, salaries, postage, stationery, and printing expenses. These common expenses are apportioned based on the gross income basis, meaning they are split proportionally between income from members and non-members.
This is the tax format. We start with the section 4A, business income. First, the gross income from members, deduct expenses and capital allowance to get adjusted income. And finally, statutory income. However, since this income comes from members, expenses, capital allowance, losses and donation are all disregarded. So no tax is charged.
Next, the exemption of the club, where the income derived from its member is not taxable as it's not considered income under Section 4 of the ITA. For example, entrance fees, membership subscription, revenue from sales to members like food, services and goods. Next, exemption under Para 13 Schedule 6 of the ITA. It is exempt because it arises from transaction with its members. Income derived from transaction with its members is not taxable. Lastly, the exemption under Para 8 Schedule 6 of the ITA, where the income of a charitable body or institution is exempt if approved by the minister. To qualify for this exemption, first, the club must apply for the approval. Second, must proven that their activities are exclusively for welfare, public benefit, and charity. Next, we move on into the last section, which is the record keeping and tax filing. For record keeping, a club is required to keep separate account in respect of income derived from transaction with members and non-members. And according to Section 28(1) of the RTA, the club must at least keep their records for at least 7 years from the end of the relevant year assessment. And last, for the tax filing, a club is required to file an income tax return form via Form TF for each of year assessment. For business income, on 30th June on the subsequent year assessment, and for non-business income, on 30th April on the subsequent year assessment.
Yes, you're correct. Club and society, while generating non-profit, are still subject to tax on income from non-members such as rent and investment. Only income from mutual dealings among members may be exempt under the mutuality principle.
To avoid penalties, these organizations must maintain proper records and comply with tax regulations. Understanding this tax obligation helps ensure smooth operations and long-term sustainability. Thank you.